let's connect with Dipan Mehta as well. And Dipan, just taking off from that conversation from the management of KEC International, they are alluding to the fact that, we can see a comeback when it comes to inquiries from overseas. They are looking at, tenders coming in as well from there. How are you looking at, the overall, the space as a whole in terms of order inquiries, execution, given that, the sector is going to be in the spotlight?
Good morning, and thank you for having me on your show. See, I think the KEC story is pretty decent. It's just that valuations capture a lot of the positive upsides. And apart from, diversifying their activities over the past several years, as well as going in for geographical diversification, there's a better degree of stability in KEC's profits. And with all these renewables and new data centers being set up, increased demand for power is going to certainly lead to higher demand for KEC's core business, which is the transmission business, where they're amongst the world leaders. So from that point of view, I think the growth prospects of KEC International are very good over the next 2-3 years, and the numbers certainly will reflect that. But a lot of the positives have got captured in the recent re-rating of the P multiple, which has taken place. So maybe at a correction of 15-20% would provide some amount of margin of safety and perhaps better returns over the longer period.
Dipan, I was just looking at the market in terms of the spike in volatility. Historically, what does that mean? I mean, if you, as a market participant, how should one look at this spike in volatility?
Yeah, good morning, Nikunj. For one, this spike in volatility means that, of course, there's more uncertainty. And it also means that if it keeps on going up the way it does, then the fear factor is more in the market. And at some point of time, it is a positive indicator that the worst is over. And from this point on, the market can again start its own upward move again. But still at 17%, it is not that high. I've seen implied vols go as high as 40-50% also if the election results do not come up to street expectations. So it's a process. And it's a very important indicator to mark, especially in times like this when such a major event is going to take place in June itself. So let's monitor it. And if it spikes even further and it is supported by further declines in stock prices, further declines in indices, then you'll have to get into a sweet spot where long-term investors will find a lot of value in the market and a lot of stocks will come into that buy zone, which we have been trying to wait and look for over the past 2-3 years or so, because there's been a runaway rally in stocks and valuations clearly are at stratospheric levels.
The stocks, and what are the buying levels that you would like to buy them?
See, I think a 10-12% correction in the Nifty, where it tests the 200-day moving average, is a good entry point. Whether that actually happens, I don't know. And I can't even tell you what the triggers could be apart from a slightly disappointing election result. So apart from that, I don't see how the market can really correct, because the liquidity flows are really coming in very, very strong into the markets by retail investors to mutual funds. And what can go wrong over there, I really don't know. So I just feel that at these levels, I think valuations are high, and investors who try to put money to work will find their returns over the next 2-3 years being subdued. Normally, I don't like to time the markets, but it's just that when I look around and look at the numbers, look at the quarterly numbers, look at the valuations on a trading 12-month basis, I just don't feel comfortable investing fresh money at these levels.
Sit on cash and you'll only buy post-elections. Can I say that?
I didn't get the question, Nikunj.
No, you are sitting on cash and you will only buy post-elections.
It's not just post-elections, it's just that we want a serious and a deep correction, and that should provide the opportunity. See, clearly what is going to do well over the next 4-5 years are the cyclical stocks, right? The company like KEC International, which we discussed, companies engaged in capital goods, maybe to an extent, some of the commodity stocks also may do well. And a lot of the other businesses which are cyclical in nature, banking also may do well. But for cyclical businesses, you need to get it at the right price point, because there's always earnings volatility over there, and that has to be compensated by low PE multiple to provide a very important and lucrative entry point. And that entry point is missing, according to me, at this point of time. At the same time, some of the secular structural growth stories clearly are slowing down. Growth rates which were easily in the mid-teens are now single-digit growth rates. And still the valuations over there also are very high. So either you want those cyclical and structural businesses in consumption space to start to revive again, go back to that double-digit type of growth rate, or you want their P multiples to compress. So either which ways you look at it, you want growth for a certain consumption-oriented stocks to move up, or the valuations to come down. At the same time, for the cyclicals and industrials, you want their actual P multiple to drop before they come at attractive levels. So I know we are asking for a lot, but that's how investment works. I think unless you don't get into the right price point, you will find that even over a 2-3 year period, the stock really hasn't delivered.
I wanted to get in your take as well on the FMCG space, because that sector has been a buzz off late, with a lot of analysts alluding to the fact that now the worst is behind. We are seeing a gradual recovery coming in. Is it time to now dip into the space if one has been on the sidelines?
No, not really. I think that worst is not over. There's a structural slowdown in the FMCG space, and if you're happy with 2-3%, 4% type of volume growth in the FMCG sector, then sure, go ahead. You may not lose much value in it. They are still remain as kind of a safe zone in a falling market. They may fall less, but you're looking for growth stocks, and clearly growth is missing in FMCG. And I would like to avoid almost all FMCG stocks. The best way to play consumption is through perhaps something like retail or healthcare, even automobiles, and some of the new generation businesses. That's the best way to play consumption in this country, and not FMCG anymore.
Some stocks that you're referring to, retail, healthcare, etc.?
I think we know all the names of, in retail, for example, stocks like Titan, Avenue Supermarket, in entertainment, Inox, PVR, healthcare, Apollo, Narayan Rudralay. And these have been classic stocks which have demonstrated consistent growth over the last 10, 12 years or so. Some of the new listings like Manyavar, Go Fashion, Campus Activewear, Ethos, there are so many options when it comes to pure play consumption. It's just that across the board, all of these companies have witnessed a sharp slowdown in their revenues, and P multiples are still in that lofty 50, 60 times trailing 12 months. So they're not attractive from that point of view. But 15, 20% type of a correction and improvement in their earnings growth or volume growth from single digit to double digit will again make them very attractive. And that's the spot that we're kind of looking for to make a serious entry into these kind of companies.
I was just looking at FMCG stocks. Now we can say, okay, 50, 60 P multiples, not historic P multiples at which you buy them. But I look at it slightly differently. These stocks have not gone anywhere in last 2-3 years. Inflation pressure seems to be easing out. Market, if it moves into defensive tilt, it may make a comeback. And this entire viewpoint which everyone had, that luxury will do well, rural will not do well, that seems to be getting dismissed now.
You're right, but we've seen a few cycles last 3-4 years or so, and still FMCG growth rate has been very tepid. And that's reason for that is that there's a very high degree of maturity in many of the FMCG categories. See, I've been a great follower of FMCG stocks for the last 15-20 years or so. So what used to work for FMCG was this rural thrust. They would keep on expanding their distribution network into tier 2, tier 3, tier 5, into the villages, and then keep on launching sachets, new products, new categories, and that used to drive their growth. At some point of time for HUL, it was M&A activity. They acquired so many companies over the last 25, 30 years or so and kept on growing their business. But at this point of time, they have completely exhausted the main growth driver, which was expansion, retail distribution expansion. That's over and done with. I think almost every single village worth its size has got access to FMCG products, and FMCG companies are present over there. At the same time, population growth for whatever it is, it's not as high as it was earlier, and people who had to consume soaps and toothpaste and stuff like that, they've already started doing it. So growth rates from that point of view have structurally come down. And when you have a situation where structurally growth rates have come down, then you could have an occasional 1 or 2 years where it goes up slightly. But it's like, running on the treadmill. End of the day, you will just remain stagnant and be over there. And it's not that they are available at 15, 20 P multiple. They are still at 50, 60 P multiple. Now, the cash you generate also, you don't know what to do with the cash because there's hardly any scope for expansion or putting it to good use. So even if you have higher cash inflows, it's not going to really benefit the shareholders. In any case, taxation is high in the hands of the shareholders, so that also prevents them from distributing it. So if you look at the composite picture, it doesn't really, provide a kind of a great growth opportunity for these stocks to deliver consistently 15-20% type of compound growth rate for the next 3 to 5 years. And whatever cash is there with investors, they should really try to look for opportunities where they can see that if they buy this stock can compound at 15, 16%, 18% over the next 3, 4 years. I think that's the basic benchmark in a market like this and an economy like this. And that's just not there with FMCG stocks.
Fair point.
All right. On that note, Dipan, gonna thank you for joining in as always and for sharing with us your thoughts on the markets.
If you like this video, then like, share and subscribe to ET Now.